Despite all of the talk about an upcoming financial crisis, the dollar has continued to rise, but experts like Jim Rickards warn that the situation could devolve into a massive recession. Jim Rickards, a former lawyer turned economist, has warned that the Fed's actions could lead to a major economic disaster. Jim Rickards is a well-known investor worth $19 million, with various ventures accounting for an estimated $4 million of his annual income. In this video, we'll get an update on inflation and the Fed's anti-inflation policies. Rickards studied international economics at Washington's Paul Nitz School of Advanced International Studies before switching to law in the 1970s, which led to his first job as a tax counsel for Citigroup. He then became general counsel at Greenwich Capital Markets, one of the largest bond dealers in the U.S. at the time. It was an exciting time to be in finance, with the rise of the derivatives market and the subsequent money splurge. After 10 years, he says he decided to leave for a startup in 1993. Calling his new company that is a little deceptive. Long-Term Capital Management, perhaps the most famous hedge fund of its time, was founded by the best bond derivative trader in the world at the time, John Meriwether, and backed by the titans of modern financial theory. The current run may last longer than anyone expects, but when it ends, it will be the biggest crash of all, and it will be too late by then. I was already in the big leagues, so for me it was like going from the Mets to the Yankees, Rickards says. Indeed, LTCM posted returns of 21%, 43%, and 41% in the first 3 years, growing its assets to $7 billion. Rickards was involved in deep financial experimentation. He claims to have laid out the legal structure of the world's first sovereign credit default swap while at LTCM, long before Blythe Masters ran with the idea at a JP Morgan offsite weekend in Boca Raton in the mid-1990s. We did the first CDS, Rickards says. My task was to determine what it meant for a country to default. Essentially, I had to sit down with a blank sheet of paper and brainstorm every possible way a country could steal your money. It was a happy era. Then in 1998, the Russian crisis struck and things turned sour. With multi-billion-dollar losses and the threat of destroying the financial system, LTCM was bailed out by the Federal Reserve and a consortium of dealers, the first and only time in history that a hedge fund had to be bailed out by the United States Supreme Financial Authority. So what went wrong here? Is that Meriwether? Hubris? Is it bad luck? In fact, none of the three are correct. Meriwether appears to have been a good person. When you're that successful, people create myths around you, like the Master of the Universe thing, Rickards says. Meriwether is a very nice guy, but he's kind of quiet, not at all bombastic, and his decision-making was based on consensus. The lack of cognitive diversity was LTCM's weakness. Running solely on talent was insufficient. The men behind LTCM had attended the same schools, learned or taught the same theories, and shared the same flaws. According to Rickards, LTCM would have been better off firing a couple of partners and hiring a landscape gardener to provide an opposing viewpoint. It was like a meeting of the fathers of financial theory. All these guys had 160 IQs. They were, however, all the same. We were missing the opposing viewpoint. By 1998, the company had $4.7 billion in equity but was running off-balance sheet derivative positions with a notional value of $1.25 trillion spread across 106 different strategies. They couldn't all fail, statistically speaking, if all of them failed at the same time. We were getting fantastic returns on equity with leverage, and it was impossible to lose money on all of the strategies at the same time, Rickards says. Statistically, that was correct. But there was one thread that connected them all and created a conditional correlation. The common thread was that they were all short volatility. When the market moved against it, everything shifted at the same time. Its weakness was a lack of diverse thinking, and it was up against a ruthless market. There was no denying the piranhas of Wall Street. At some point, word gets out and people realize you're in trouble, and the market systematically trades against you, Rickards says. You can't change that because Wall Street is like a shoal of fish devouring you. They won't stop until the last morsel is gone. Why should they be kind to you? The size of the position was revealed during a meeting with the Fed on September 20th, when Rickards and the company's founders went through term sheet after term sheet outlining the fund's position. Peter Fisher, the Fed's number 2, was white by the end of it. He said, "I knew you were going to destroy the bond market, but I didn't realize you were going to destroy the equity market as well," Rickards recalls. "I could have slept in the next day because there was nothing else to do, but the entire world would have come crashing down." According to Rickards, it was a lesson in mismanagement, but he was fortunate not to be the risk manager. Soon after, he was recruited by the CIA to assist with counter-terrorism operations in the aftermath of 9/11. This is where the story becomes extremely conspiratorial. According to Rickards, massive insider trading occurred in the 2 days preceding 9/11, when the market saw 286 times the average daily volume of puts traded on American Airlines and United Airlines, the companies whose planes were used in the attack. The CIA wanted to see how similar information could be used to prevent future attacks. I inquire as to why the insider trading story did not garner more attention at the time. No one wants to talk about it, and the government refused to discuss it, he says simply. Rickards and his team received funding from In-Q-Tel, the CIA's enigmatic in-house venture capital arm. It enabled them to build a machine based on predictive analytics to analyze market data, dubbed Project Prophecy by the CIA. The results are shocking. On August 10, 2006, Rickards received a phone call from a business partner informing him that American Airlines had a bright red indicator. That escalated, he says. Nothing happened for a couple of days, no hijacking, nothing. The next day, I turn on CNN and there is Scotland Yard breaking down doors on the news, foiling the liquid bomb plot. We received it 5 days in advance. It is an astonishing claim. In fact, Rickards claims that the machine worked so well that they were referring cases to the SEC until they were yelled at by the CIA for not being a police agency and had to stop talking to financial regulators. However, there is more. Rickards gave an interview in June 2016 in which he stated his belief that the UK would leave the EU and advised viewers to short sterling and go long gold based on the machine's information, which was now under a private venture, Raven, by Mariglim. Those who listened, it paid for their kids' college, he says. In October 2016, just days before the US election, he predicted Trump's victory. Everyone was surprised, but that's what happened. It wasn't a guess. These are difficult claims to refute, but despite his Nostradamus-like prophecy abilities, Rickards is incorrect. Indeed, he has been predicting an impending market crash for at least 3 years. So far, nothing has happened, but Rickards is persuaded. Recessions are difficult to forecast, but expansions do end, he says. We no longer have markets because the Fed manipulates everything. Nothing could be more obvious than the stock market driving their interest rate policy. The Fed should be plotting an even path between the Scylla and Charybdis of higher interest rates and the market's insatiable appetite for expansion, but so far it appears to have followed the latter's whims. According to Rickards, the stock market is like a child who needs candy to stop misbehaving. However, it will soon crave more candy. The Fed should be raising interest rates to prepare for the next recession and normalizing interest rate policy, he says, but they can't, not without crashing the stock market. They've made it clear that markets come first. But what should an investor do when the only thing keeping stocks afloat is Fed policy? It's a huge house of cards that could collapse at any time, and the longer it goes, the worse the outcome. At the very least, Rickards has forewarned us. And with that being said, it's time to end our video. Subscribe to the channel for more amazing videos like this. We'll see you with another interesting video.